Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of finance and talk about how companies are really doing. And let me tell you, AVITA Medical has some interesting news to share. So get ready because things are about to get a little bit more interesting. Before we dive in, make sure to hit that subscribe button if you love getting straight insights from these corporate filings. And hey, we've got a great community over on Discord. The link is in the description below. So come join the conversation. Today we are looking at a Form 8K filing from AVITA Medical Incorporated. Now, what is an 8K, you ask? Think of it as a current report, like a headline that tells you something important just happened. And for AVITA Medical, something significant did indeed happen on the 13th of January 2026. AVITA Medical, through its wholly owned subsidiary AVITA Medical Americas LLC, has entered into a new credit agreement and a security agreement. This is basically a new loan arrangement. The company, as the borrower, is getting a 5-year senior secured credit facility. That is a fancy way of saying a loan that is backed by assets, with a pretty long repayment period. The total amount they can borrow is up to $60 million. On the day of the agreement, they immediately drew down $50 million of this amount. The remaining $10 million can be accessed later by the 31st of March 2027, but only if they meet a certain revenue target. This is important because it shows they are securing significant funding, but there are conditions attached to the full amount. What is also key here is that this new loan facility allowed them to pay off and completely cancel their old loan agreements. This is called a refinancing transaction. They were able to extinguish all their prior debt, which is often a sign of improved financial health or a strategic move to get better terms. Now let's talk about the cost of this money. The interest rate on the loan is tied to the SOFR rate, which is a benchmark interest rate or a base rate of 4.00%, whichever is higher. On top of that, there is a 7.50% spread. So if SOFR is low, they're definitely paying a significant premium. If an event of default happens, that interest rate goes up by an additional 4.00%. This means the cost of borrowing is substantial and higher than many typical corporate loans, indicating the lender perceives a higher risk or is demanding a premium for providing this facility. There is a really interesting clause here. The company could owe a hefty exit fee of 5% of the borrowed amount if they don't get shareholder approval for issuing warrants by the 30th of September 2026. And get this, if they don't get that shareholder approval by the 30th of November 2026. It is considered an event of default under this new credit agreement. This links their ability to secure funding directly to shareholder decisions and potential dilution. The agreement also has covenants, which are basically rules the company must follow. These include restrictions on creating liens, taking on more debt, merging, or selling assets. Crucially, they must maintain a minimum net revenue for every rolling 12-month period. This means their revenue needs to hit certain targets continuously. On top of that, they have to keep at least $5 million in unrestricted cash at all times. These are strong protective measures for the lender. To top it all off, the loan is secured by pretty much all of the company's and its subsidiaries' assets. So if things go south, the lender has a strong claim on the company's property. Now, alongside this credit facility, AVITA Medical and the lender agreed to the issuance of a warrant certificate. A warrant is essentially an option to buy shares of the company's stock at a predetermined price. This warrant allows the lender to buy up to 500,000 shares of AVITA Medical's common stock. If the company draws down that additional $10 million loan later, an extra 150,000 shares become available under the warrant. The exercise price is based on the trading price around the time of the agreement. Warrants are often used as a sweetener for lenders, giving them potential upside if the company's stock price increases. The company has also committed to filing a registration statement for these warrant shares. This means they are preparing to make these shares available for the lender to sell on the open market, and they need to get that registration approved fairly quickly. The offer and sale of these warrants are exempt from standard registration requirements because they are considered private placements to an accredited investor, meaning the lender is sophisticated and buying for investment. Remember that refinancing we talked about? Well, this part confirms it. On the same day, the 13th of January 2026, AVITA Medical repaid all its outstanding debts under its old credit agreement, which was with an affiliate of Orbimed Advisors LLC. So that chapter is officially closed. However, any warrants previously issued under that old agreement remain valid. The filing also mentions that on the same day, AVITA Medical issued a press release. This press release contained updates on their expected revenue for the fourth quarter and the full year of 2025, and also gave their revenue outlook for 2026. This is a crucial piece of information for investors as it directly communicates the company's performance and future expectations. The creation of this new credit facility is a direct financial obligation. The company has taken on new debt, which is clearly laid out in item 1.01. This confirms the significant financial commitment they've just made. And as we wrap up the exhibits section, we see listed the form of the warrant certificate, the credit agreement itself, the security agreement, and a fee letter detailing all the costs associated. This is where the actual legal documents are filed. So what does all this mean for AVITA Medical? On one hand, they've secured a significant amount of funding, $50 million immediately with the potential for another $10 million. They've also cleared out their old debt, which is a positive step. The warrants issued to the lender could also signal future growth if the company executes well and its stock price rises. However, the terms of this new loan are quite strict. The interest rate is high. There are significant penalties for failing to get shareholder approval for warrants, and the company must maintain specific revenue and cash levels. The fact that they needed to take on this kind of secured debt facility with such stringent conditions and warrants suggests that traditional lending options might have been less favorable or unavailable. It points to a company that requires substantial capital potentially for growth or operational needs, and is willing to accept tough terms to get it. The reliance on shareholder approval for warrants also introduces an element of uncertainty. They are making a big bet on their future revenue and their ability to navigate these new financial waters. What is your take on AVITA Medical's new credit facility and the warrants issued? Do you think these terms are a sign of strength or a cause for concern? Let me know your thoughts in the comments below if you found this breakdown helpful. Please give it a thumbs up and subscribe for more in-depth looks at corporate filings. And of course, don't forget to join us on Discord. Link is in the description. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.